everyone, welcome to my channel. Hope everyone has a great day. Thank you for your interest in my video, and let's start our today's sharing. The company has been stuck in a loss financial status for many years until in 2023. Its revenue achieved a threefold increase at 55 million compared to 2022, and it marked the first profitable year, with net profit sitting at 9 million. The share market has responded quickly at its remarkable performance, selling a share price from 22 cents on the 1st of January 2023 to 40 cents at the 31st of December 2023, and to an eye-popping price sitting at $1.8 as at 21st of June in 2024. Both institutionals and retail investors are flocking into the stock, fearing to miss such a cash cow company. So let's quickly go through the background of this company, Droneshield. Founded in 2014, Droneshield has been delving into counter-drone business. It provides an AI-based platform for protection against threats from drones and other autonomous systems. It has a vast range of products, such as the end users of Droneshield products come from various global sectors, such as defense and intelligence agencies, airports and other civil defense users, ports, prisons, stadiums, but the current main area is defense due to the heated geographical conflict. As we can imagine, it is mainly a business-to-business model, and the major customers are the US and Australian governments. The global counter-drone market is massive and is growing. Its main revenue stream is sale of hardware, subscription services for software updates, and services for research and training. For the sale of hardware, you will either sell to customers or distributors and book a deferred revenue when they place the orders and are invoiced. The revenue won't be recognized until the control of the hardware has been transferred to the buyers. The one-off hardware sales are the major contributors, while the following services sale can generate an everlasting and stable income stream. These services are like a complementary bundle sale with the hardware. As reviewed by the annual report, direct sales to customers took a much higher proportion than sale to distributors, and the largest direct sale customers is the US government, contributing 70% of revenue in 2023. The second contract has been signed and posted in the company's announcement. Even though the US government has high financial deficits, they are still a reliable customer with 30 days payment term. In the first quarter 2024, the company has demonstrated a strong revenue growth at 16.5 million. 10 times the total revenue in the first quarter 2023. Out of the total sales, the service revenue has doubled to 561K compared to 239K in the first quarter 2023. Its growth potential is certain, with so many pipelines on hand. We all know its buoyant revenue growth, but what about its gross profits? I picked out the cost of sales from the annual report and do a simple calculation. From my personal perspective, it has a decent margin and is growing, which is a good sign. For the other expenses, I have categorized them into 3 sections, with the first 2 being more important and directly related to the business performance. I have renamed product development expenses as R&D. I try to work out the proportion of the R&D expenses out of the total revenue. R&D expenditure has doubled, while revenue increased more. As it is an AI-driven system, it is quite certain that the company will keep investing funds into the R&D in order to enhance its market share. We can pay attention to their future reports. The majority is the payroll, or to be more specific, I think it's the engineers' wages. I have reclassified the sales into marketing. It is acceptable and reasonable with such a proportion of marketing fees because the latest products will come out from the R&D and need to be sold by the salesperson so they can realize the revenue. We might need to be cautious if the proportion remains stable in future. Normally, they need to pay tax, and we should expect to see an outgoing income tax expense. However, it has received 6 million R&D tax benefit instead, which may be fluctuating in the future. From an investing perspective, even without the tax incentive subsidy, Droneshield's net profit will be 3 million, which means it can live by its own business now. As we mentioned above, Droneshield's main customers are the US government and Australian government, so we may expect that it will receive the funds on time and won't have any bad debts, which can be proved by the balance sheet items. However, no further details of high prepayments are provided, so from my own perspective, I think it's the payments for manufacturers due to the increasing numbers of contracts received. To support the sales, we can expect a high portion of inventories and more expenditure in PPE. By comparing the inventory turnover ratio between 2022 and 2023, we know the inventory management is getting more and more efficient, and it will take only 269 days to sell off all its inventory. We're happy to see the day sales getting lower and lower in the future. For the PPE, we can find it has spent nearly 2.5 million in adding new assets. By comparing the asset turnover ratio, we can still see a decent, efficient result. We're happy to see an increase of AP as it means Droneshield might have more bargaining power against the vendors. To be more specific, I tried to calculate the days payable outstanding, and it looks like Droneshield is paying vendors slower. However, remember the 6 million prepayment mentioned above? We're not sure are all the prepayments for vendors manufacturing. It might need to pay attention in the future reports. So let's break down the other liabilities. 800K deferred revenue will convert to revenue gradually. However, Droneshield has already received the money, which is positive news for current cash flow and future profits. Its high net profit corresponds to the high positive operating cash flow. I do a simple calculation to test its earnings quality by dividing operating cash, which means for $1 net profit, it can generate $1.02 cash in the pocket. However, the net profit is GST exclusive, so after excluding the GST impact, the ratio still looks strong. The total net increase in cash flow is 46 million, out of which 9 million is generated from daily business, while the rest is from equity raising. With so many funds sitting at the bank, it may pay attention to its future expenditure in building more production lines and R&D to increase the manufacturing efficiency and further enhance its product edge. However, in its first quarter 2024 report, the operating cash flow is negative, which is mainly because of the payment timing issue, so it won't be a big concern. From the financial reports, it proves itself as a healthy business, but does the soaring price deviate from its fundamental value? I try to work out the valuation using very general and conservative method. Please just take it as an amateur analysis and do your own research. From all the published reports, we can collect some facts. The 2023 net profit, 9.3 million, including 6 million tax subsidy. Total revenue is 55 million. So we can work out the net profit margin is roughly 70%. We know the 2024 first quarter revenue. The current outstanding shares is 762 million, current PE ratio, and the recent share price. I try to apply PEG ratio here and put 3 scenarios to indicate different situations. Apparently, Droneshield will see a massive increase in revenue in financial year 2024, but we are not sure about its net profit growth. If it can double, then the current share price seems undervalued. If it only increased by 50%, perhaps the current price is overvalued. To maintain the current PE, its net profit should reach 15 million. If we assume in financial year 2024, its net profit margin is still the same as 2023, then the total revenue should be 90 million, nearly double 2023 revenue. But remember, it has received so many contracts. And if you add up all the contract value, it's roughly another extra 50 million. From all its pipelines and backlogs and contract, I think it's achievable. So my conclusion is perhaps it's not overvalued, but it will be tested by the market. Please leave your valuable comments down below if you have different ideas.